The next two upside goals for gold, according to Fibonacci extensions alone, are approximately 3,730 and 4,100. This was also discussed in our most recent precious metals forecast report, which was over a month ago. Therefore, that's a good move. In keeping with previous observations, it so happens that the 15% breakthrough occurs when we simply take the tool from this bull flag. In this case, I like gold. The gold market is experiencing a price explosion. The chart design is just stunning. The price might rise and reach much higher than 41 though. The same may be said for silver. In my opinion, the price of silver might rise sharply and reach $50 per ounce. Plenty of opportunities for improvement exist. As things stand, it's close to 16%. It follows that I am, and have been for a long time, bullish along both. If you're looking for a tangible kind of money with a rich history and inherent value, go no further than gold. After a period of consolidation, gold is regaining its vigor and heading back toward its main upside goals. The chart implies that you should keep an eye on the levels around $3,730 and $4,100 using Fibonacci extensions. Silver might potentially rise to $50 per ounce, which would be in line with its historic highs. The price of gold has risen in 15% increments, with pauses in between. And this breakout seems to follow the same pattern. Hard assets, rather than conventional stocks, are continuing to benefit from prevailing macroeconomic concerns, and technical signs are in line with this trend. In a market when stocks are sending warning signals, Chris Vermeul and Lynn Alden emphasize how silver's explosive potential and gold's tidy chart structure make them outstanding plays. Confirmation of the rise has come from miners, with major caps hitting new highs and junior miners soon to follow. In the past, when miners took the lead, it bolstered the argument for continued rises in the metals. With solid fundamental support, unambiguous breakout patterns, and robust technicals, this is the kind of setup that traders dream of. Here are snippets from the interview with Chris Vermeul and Lynn Alden. Please subscribe to our channel and enable the bell symbol to receive timely updates before we continue to discuss this. Please enjoy the video and thank you. Furthermore, observing the gold chart illustrates that this is merely the most recent upswing. In an off-camera comment, you said that gold often follows a pattern of 15% gains, followed by a lull of a few months and then another 15% rally. As you pointed out, it simply continues doing that. By utilizing Fibonacci extensions, we may deduce the next two upside goals for gold from this last major bull flag pattern are approximately 3,730 and 4,100. This was also discussed in our most recent precious metals forecast report, which was over a month ago. Therefore, that's a good move. And naturally, this is at the 15% breakout level, as we have seen in previous instances, if we simply take the tool and apply it to this bull flag. As a result, gold is my favorite here. The gold market is experiencing a price explosion. The chart design is just stunning. And a lot of signs are pointing to the possibility that the stock market's good times are about to end. Lots of sales have been reported. At the moment, I believe precious metals are the best investment option. In a perfect world, we'd love to see the weekly close somewhere above this resistance level. On Friday, fresh information will be released. A Federal Reserve pronouncement could assist them in deciding if they would do a quarter basis or not. I believe we have jobs or something along those lines. A sudden decrease in value, which will have a profound impact on several markets, including gold, interest rates, and stocks. Therefore, the market is likely to experience significant volatility this week. Plus, I believe gold may easily take a breather or retreat. A minor hitch may be necessary in this area. This might return and find a comfortable home in these highs. However, it appears that the momentum has turned positive. From the looks of things, the markets are on a break today, or more accurately, it was a break on Friday. To be more specific, I enjoy perusing the ETFs. We discussed this briefly in our last meeting. Regular trading hours are the only ones shown here for the Sprott ETF. Also, it's satisfying for me when the market reaches new highs. I was expecting a closing above these levels. It would be highly encouraging if it could close above these levels reached a few months ago. The market is currently exploding and bursting out. after that event on Friday. So it appears to be a legitimate breakout when you consider that most trading volume occurs during regular trading hours, Craig. So, yeah, I take it as a sign that there is sufficient volume and the market is prepared to hold overnight in the hopes of further gains when it closes here during regular trading hours. Thus, it appears that gold is emerging. For their first aim, we anticipate a 6% to 5% increase. And for their second target, we anticipate a 15% to 18% increase. And it might happen in a flash. That might happen in as little as a month or two, at the most. In my opinion, the stock market is about to crash. Similar to the surging stock market, just when it's about to plummet, gold can stage that parabolic rise, skyrocket, and maybe even surpass it. We really had something very similar in 2008. It seemed like gold was set to have a 20% rise. We reached a key turning point in the market, and as a result, it ended up surging 37%. At the bottom of a market, you'll see blow-off tops and panic washout lows. As a result, we may have reached that critical juncture. In other words, gold might reach 41, but it might also surge and go much higher. The same may be said for silver. In my opinion, the price of silver might rise sharply and reach $50 per ounce. Take a look at the silver chart. It's incredibly bullish and pointing to a final blow-off and a squeeze up here, particularly when you look at the monthly chart. You are aware that silver, once that train begins, can become a rocket ship. Regarding removable tops, and silver has a lot of whipsaw and is a rather noisy chart. I believe the image would be somewhat clearer if we switch to the weekly chart. Allow me to simply remove these lines. Several possible levels of silver's potential future price could be examined using Fibonacci extension. A low may be taken here, and this run might be extended up and down to this spot. And this is where silver could surge and burst. This works out to over $49. Think about it. Going back in time, that was essentially the previous peak, give or take a couple of dollars. By that moment, if we begin to shoot up, the price will likely jump significantly, perhaps piercing through 50. It will then either try to run out any shorts, if any, or it will rally due to the short squeeze. Thus, there is a great deal of opportunity for improvement. As things stand, it's close to 16%. Additionally, I brought this up when we last spoke. From a technical perspective, the prospective gains for silver and gold are almost equal, which is really amusing. Additionally, I prefer gold since it increases my trading success rate. According to my gold trading strategy, I have a substantially better chance of success when using chart patterns. So if the two have equal potential for growth, I choose gold due to its lack of volatility, shakeouts, and fakeouts. We can also produce the same quantity of silver. Here is my perspective. In my opinion, they are both good. However, I believe that gold is the more rational investment option because it appears to offer the same potential reward with less noise. However, silver miners are also experiencing a surge in value. That is the benefit of applying the Fibonacci extensions that we demonstrated. 2 upside targets are shown. With each fresh break in the market, you get a chance to reevaluate your position and determine the best course of action, including the next 2 upside goals. As a result, silver hit a new low of like $49 per ounce. That is the beauty of technicals then. With the right resources, you can even anticipate when that run will need to slow down a little. By the time it reaches those goals, I normally cut back, lock in gains, and raise my stops in case it takes a break. Then, during our hiccup, there will be a natural pause. If it begins to turn and rally again, I can effortlessly draw the new extension and know that it is breaking out of the small bull flag and heading towards the next upside objective. Thus, you can trade in uncharted territory by utilizing technical analysis. If you want to know where support is, where a trend should bounce from, or when markets reach new all-time highs, Fibonacci is your single and most effective instrument. Thus, it is highly effective. In order to trade the markets, I had to choose between 4 things. 2 moving averages, one for 20 days and one for 5 days, would make it. Generally speaking, an uptrend is present when both the 20-day and 5-day moving averages are sloping upwards. You are in a downtrend if the 5-day moving average is lower than it and there is a downward trend. Once you see a trend, you can trade like a swing trader. Then, to determine your upward targets, use Fibonacci extensions. To determine the location of support and the expected hold of a downturn, use Fibonacci retracements. You can stay in sync with the trend and identify support and targets. Those are the 4 most valuable things it offers. Unless you're planning to buy and hold, an approach I really dislike, that's essentially your only option for gauging. You just have to know your way around the markets like that.